Hello guys, I welcome you to Global Tech on Tube with our fourth video about IAS 8, accounting policies, changes in accounting estimates and errors. I'm not going to take long, I'm just going to move towards the IAS 8, the overview, accounting policies, changes in accounting estimates and errors. Is applied in selecting and applying accounting policies, accounting for changes in estimates, and reflecting corrections of prior period errors. The standard requires compliance with any specific IFRS applying to a transaction, event, or condition, and provides guidance on developing accounting policies for other items that result in relevant and reliable information. You have to keep in mind changes in accounting policies and corrections of errors are generally retrospectively accounted for, whereas changes in accounting estimates are generally accounted for on a prospective basis. IAS 8 was reissued in December 2005 and applies to annual reports beginning on and after 1 Jan 2005. So, talking about the key definitions covering in IAS 8, one is accounting policies. The policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. And the second one is a change in accounting estimate, is an adjustment of the carrying amount of an asset or liability or related expense resulting from reassessing the expected future benefits and obligations associated with that asset or liability. The third one is International Financial Reporting Standards, are standards and interpretations adopted by the International Financial Accounting Standards Board, IASB, and they comprise International Financial Reporting Standards, IFRS, and International Accounting Standards, IAS. And these both standards are being developed by interpretations and developed by the International Financial Reporting Interpretations Committee, IFRIC, or the former Standing Interpretations Committee, SIC, and approved by the International Accounting Standard Board. The most important definition that we're going to cover right now is materiality. Information is material if omitting, misstating, or obscuring if it would reasonably be expected to influence decisions that the primary users of general purpose financial statements make on the basis of those financial statements, which provide financial information about a specific reporting entity. And also one of the most key definitions that you come across in the standard is prior period errors. Are omissions from and misstatements in an entity's financial statements for one or more prior periods arising for a failure to use or misuse of reliable information that was available and could reasonably be expected to have been obtained and taken into account in preparing those statements. Such errors result from mathematical mistakes in applying accounting policies, oversights, or misinterpretations of facts and fraud. And you have to keep in mind in the absence of a standard or interpretation that specifically applies to a transaction, other event, or condition, management must use its judgment in developing and applying an accounting policy that results in information that is relevant and reliable. In making that judgment, management must refer to and consider the applicability of the following sources in descending order. The first one will be the requirements and guidance in International Accounting Standard Board standards and interpretations dealing with similar and related issues, and the definitions, recognition criteria, and measurement concepts for assets, liabilities, income, and expenses in the framework. Management may also consider the most recent pronouncements of other standard-setting bodies that use a similar conceptual framework to develop accounting standards, other accounting literature, and accepted industry practices, to the extent that these do not conflict with the sources in above-mentioned lines. And consistency of accounting policies An entity shall reflect and apply its accounting policies consistently for similar transactions, other events, and conditions, unless a standard or interpretation specifically requires or permits categories of items for which different policies may be appropriate. If a standard or interpretation requires or permits such a categorization, an appropriate accounting policy shall be selected and applied consistently to each category. And now I'm going to talk about some of the other aspects of IAS 8 that are the most important aspects are the changes in accounting policies, and also what are the changes and the relevant disclosure in this standard. The first one that we're going to talk about is about changes in accounting policies. And an entity is permitted to change an accounting policy only if the change is required by the standard or interpretation, as discussed above, or results in the financial statements providing reliable and more relevant information about the effects of transactions, other events, or conditions on the entity's financial position, financial performance, or cash flows. Note that changes in accounting policies do not include applying an accounting policy to a kind of transaction or event that did not occur previously or were immaterial. If a change in accounting policy is required by a new IASB standard or interpretation, the change is accounted for as required by that new pronouncement, or if the new pronouncement does not include specific transition provisions, then the change in accounting policy is applied retrospectively. And retrospective application means adjusting the opening balance of each effective component of equity for the earliest prior period presented and the comparative amounts disclosed for each period presented as if the new accounting policy had always been applied. And the disclosures for relating to changes in accounting policies. First one is the title of the standard or interpretation causing the change. The second one is the nature of the change in accounting policy. Third one, a description of the transitional provisionals, including those that might have an effect on future periods. And the fourth one is for the current period and each prior period presented to the extent practicable. The amount of the adjustment for each financial statement line item affected and for basic and diluted earnings per share only. And now I'm going to just discuss about the other changes, that is of changes in accounting estimates. The effect of a change in accounting estimate shall be recognized prospectively by including it in a profit or loss in the period of the change if the change affects that period only, or the period of the change and future periods if the change affects both. Disclosures relating to changes in accounting estimates are the nature and amount of a change in accounting estimate that has an effect in the current period or is expected to have an effect in future periods. If the amount of the effect in future periods is not disclosed because estimating it is impracticable, an entity shall disclose that effect. And the third one, the changes in errors. The general principle in IAS 8 is that an entity must correct all material prior period errors retrospectively in the first set of financial statements authorized for issue after that discovery by restating the comparative amounts for the prior periods presented in which the error occurred, or if the error occurred before the earliest prior period presented, restating the opening balances of asset, liabilities, and equity for the earliest prior period presented. And the disclosures for relating to prior period errors are the nature of the prior period error for each prior period presented to the extent practicable, the amount of the correction for each financial statement line item effective, and for basic and diluted earnings per share. And the third disclosure would be the amount of the correction at the beginning of the earliest prior period presented, and if retrospective restatement is impracticable, an explanation and description of how the error has been corrected. And financial statements of subsequent periods need not repeat these disclosures. So I hope that you're going to like the discussion about IAS 8. Which is about you can have the explanation about accounting policies, change in accounting estimates and errors, and I have discussed about how is that being presented or explained in IAS 8, some of the features of IAS 8, the definitions, and that can be included in MCQs as well. And also you can just go through the important part of the standard, that are the policies, estimates and errors, the changes, and the relevant disclosures that is a must in a financial statement. So I'll just going to end my video over here. I hope any questions would be commented so that I can reply accordingly. I hope that you're going to keep watching the coming videos as well. Thank you again for listening and watching to the content, and you can ask any questions further. Thank you very much again. Take care and have a nice day.